Greetings and welcome to the SB News Podcast. In this podcast, we will delve into the foundational aspects of the economy and analyze their implications on the futures, Forex, and the stock market. Please note that any opinions shared herein are intended solely for informational purposes and should not be construed as investment advice. Today, we shall examine the present progress of the Japanese economy, drawing insights from the deliberations of the Bank of Japan's monetary policy meeting held in July. Japan's economy has shown a moderate resurgence, and this trend is likely to persist due to factors like the realization of pent-up demand. However, there exists a high degree of uncertainty surrounding economic activities and price levels in Japan. While the recovery pace of foreign economies has slackened, local businesses and households have experienced an upward shift in confidence, and companies' investments in fixed business assets have risen. Numerous business leaders have begun advocating for salary hikes to enhance employee recruitment and retention efforts. Encouraging progress has been observed in the income landscape. Certain companies have committed to not only raise wages for a single fiscal year but also for the foreseeable future. This implies that such endeavors are imperative in the current circumstances to secure and keep talented employees, thereby contributing to a reinforcing cycle of economic growth. A division has emerged between enterprises pursuing wage and price hikes through value-added initiatives and investments and those adhering to a strategy of maintaining low wages, minimal value addition, and discounted prices. The shift to the former type of enterprise as the prevailing model has not yet been accomplished. Achieving inflation accompanied by wage hikes still requires substantial progress. To harness the opportunity to eliminate deflationary tendencies, the central bank must comprehensively comprehend the status of economic and wage structure reforms and meticulously evaluate economic activities and price trends. This will prevent a decline in investment appetite among small and medium-sized enterprises, which had seen an uptick in borrowing during the COVID-19 pandemic. Facilitating continued assistance for small and medium-sized businesses by regional financial institutions is crucial for bolstering their operational resources, including facilitating business succession to encourage transformation within these companies. Furthermore, to invigorate growth expectations and reshape the prevailing deflationary sentiment, attaining growth in nominal GDP, along with economic and wage structures favoring larger increases in nominal wages compared to prices, is of paramount importance. The year-over-year growth rate of the Consumer Price Index, CPI, is expected to slow down, as the impact of translating cost increases, driven by previous rises in import prices, to consumer prices diminishes. Following this, the pace of increase is predicted to moderately pick up once again. Despite projections that higher wages will contribute to pushing up inflation, this effect may be counteracted by a decrease in import prices, resulting in a gradual deceleration. However, prices are anticipated to reverse course as global economies recover. Efforts to rapidly translate rising costs into selling prices may pause in the fiscal year 2023, given the anticipation of robust corporate profits resulting from recent adjustments. Nevertheless, companies are likely to continue the gradual process of passing on previous cost hikes to prices. The upward deviation of projected inflation for fiscal 2023 from the baseline scenario is mainly due to the prolonged impact of import price-driven cost pressures on prices. As shifts in wage and pricing behaviors become evident within firms, it is crucial to closely monitor their effects on price levels. The continuity of wage increases in the upcoming year will be a significant point of concern. The year-on-year CPI change is predicted to dip below the 2% mark in the latter half of fiscal 2023. To subsequently bring this rate back up to 2% and sustain it steadily, the establishment of a trend in which wage growth surpasses the agreed-upon rate from this year's spring labor management wage negotiations is vital. While price hikes have been concentrated in goods due to cost-driven factors since the previous year, the substantial base pay increases this spring have spurred more companies to contemplate wage hikes for the next fiscal year and beyond. As a result, a new phase is likely to emerge wherein wages and service prices experience ongoing growth. In terms of the price outlook, a departure from the baseline scenario is conceivable if firms widely adopt practices of passing cost increases to selling prices against the backdrop of wage hikes prompted by tighter labor market conditions. Recent wage increases and the transmission of cost hikes by firms have been pent-up phenomena, as these actions had been restrained for nearly 3 decades. Consequently, wages and selling prices could continue to rise at a pace unprecedented in the past. The central bank should continue its patient implementation of monetary easing to reach the target of price stability. To achieve the sustainable and stable goal of a 2% inflation rate, the bank must persistently support wage increases through ongoing monetary easing. Since the attainment of a consistent 2% price stability remains distant, any consideration of revising the negative interest rate policy is premature. The framework of yield curve control should be maintained according to the bank's established commitment. Should upward price movements and inflation expectations continue, monetary easing effects will strengthen. Conversely, rigidly capping 10-year Japanese government bond yields at 0.5% could disrupt bond markets and financial market volatility. Given the substantial uncertainties in economic activity and prices, as demonstrated by a sudden significant upward deviation from baseline inflation projections, it is appropriate for the bank to adopt a more flexible approach to yield curve control. This will enable the bank to maintain its monetary easing strategy while nimbly addressing both upside and downside risks, considering market functioning. Maintaining low and stable long-term interest rates is key to achieving the 2% price stability target. Until the likelihood of hitting the target increases considerably, the bank should sustain yield curve control while incorporating increased flexibility. To ensure smooth and prolonged monetary easing, the bank should enhance the flexibility of yield curve control proactively and in a controlled manner. Flexibility in yield curve control is challenging but necessary. A responsive framework tailored to the situation should be implemented. As the prospect of sustainable and stable 2% inflation becomes clearer, the bank should maintain its basic stance of monetary easing while allowing greater flexibility in yield curve control. This will help balance the positive effects of easing, such as reduced real interest rates, with potential side effects, including market volatility. When inflation expectations rise alongside capped long-term interest rates, the positive impact of monetary easing strengthens through lower real interest rates. Allowing some moderate increase in long-term rates in response to price trends can stabilize real interest rates while managing side effects and preserving positive effects. In implementing more flexible yield curve control, several considerations are essential: allowing market-determined interest rates where possible, enhancing and recovering market liquidity, and preventing abrupt interest rate fluctuations. The bank should conduct operations while accounting for these factors. As economic and price conditions improve, some investors have held off on bond investments due to uncertainties in future interest rate trends. Thus, it's appropriate for the bank to conduct monetary policy that accommodates market functioning while maintaining favorable financial conditions. Current price increases are primarily import-related inflation. To bolster wage increases, particularly for small and medium-sized businesses, which employ in Japan, it's crucial to enhance the earning capacity of these firms. Therefore, greater flexibility in yield curve control should be considered after confirming improved earnings among these firms. Thank you for tuning in to the SB News. Please subscribe, like, and download our podcast. Your support greatly assists us in delivering further content of this nature to your attention. Fundamental analysis of economy for Forex, future and stock market.